Hello, welcome to this session on a new dynamic, relations between the US and China. My name is Simon Cox. I'm Emerging Markets Editor for The Economist, based in Hong Kong. And I've been keeping an eye on the dynamics between China and the US for over 10 years now. It's very interesting. We saw just a month ago Xi Jinping outlining new targets, new goals for China's economy, the hope that it would double in size by 2035. I looked up whether other economies that had reached a similar level of development to China had managed that feat. And it's quite hard to find any examples. Japan actually didn't quite manage to double once it had reached China's level of development. South Korea did manage it, but in between, it suffered a calamitous financial crisis in 1998. So these goals that suggest great stability also include the possibility of huge tumult. And of course, we're finishing a tumultuous year, the pandemic, the US election, all the news we've seen in recent weeks about new financial regulations in China, the postponed IPO of Ant. There's a great deal to discuss. And so I'm joined by a fantastic panel. I'm very much looking forward to the discussion. Let me briefly introduce them all to you. I'm joined by Zhai Chenxi, who is Vice President of Tianfeng Securities, by Eric Robertsen, Head of Global Research at Standard Chartered, Patrick Springer, who is Managing Director at Huatai Securities, but based in New York, and also Kevin Rideout, who's Managing Director of Hong Kong Exchange, HKEX, here where I live. Welcome to all of you. Eric, perhaps if I could start with you. Do you think this goal of doubling China's economy by 2035 is feasible?
Well, Simon, as you say, I guess the odds historically are perhaps not in China's favor, but I think what we've learned over the last 10 years is that through a number of crises as well as economic booms, China has been able to manage the trajectory of its domestic economy extremely well. A number of years ago, they set a goal for shifting the composition of growth away from manufacturing and exports towards the services sector, towards domestic consumption. And lo and behold, they've managed to achieve that pretty well. If you go back to the global financial crisis, we had obviously China initiating a massive credit and monetary impulse to rescue their domestic economy. But as we all know, there was a significant amount of leverage left in the system. This time around, with the current crisis, they've managed to achieve a very wholesome recovery without nearly as much leverage deployed into the system. So the idea that China has very good control of its economic trajectory, I think, is still largely pointing in the right direction.
Some of that control, though, relies on a financial system that's largely domestic. And of course, one of the reforms we've seen recently in China is a move towards financial coupling. It was the subject of the fireside chat that just finished. Do you think, therefore, that China perhaps faces a more difficult trade-off between stability and growth over the next 15 years?
Well, look, I think if you go back about 5 years, in our opinion, that was when they really started to prioritize the quality of growth and stability rather than just the absolute level of growth. And that was when we first saw evidence of the deleveraging campaign. We saw the first washout in the onshore fixed income market. But I think what we have seen evidence of, especially over the last year or two, is that they haven't sacrificed that much on the growth side, even though they've made significant forward strides in terms of, again, the quality of growth, the deleveraging, and getting some of the issues like shadow banking under control. So, again, I think there are obviously risks in terms of leverage. There are obviously risks in terms of how they manage both their domestic and international exposure. But I still think the odds are very much in favor of a net positive trajectory.
Zhai Chenxi, perhaps if I could ask the same question to you. Do you think this goal of doubling China's economy by 2035 is feasible?
Okay, thank you for your question. According to my view, I think it's quite feasible. As you have mentioned, as to the Chinese government, they face some contradiction between the quality and the growth. So I would like to share some views about this. The first one is that, as we all know, during the past maybe 3 to 4 years, the the relationship between the different countries like China and the U.S. is a little tension. So Chinese government beginning to start to switch the focus to the domestic demand. So we call it dual circulation policy. So from this year, the government paid a lot of attention to stimulate the local demand of the China. So that's the first point. The second point is that the Chinese government pay more attention to the technology, to the innovation. So from the last 2 years, the local government, put more emphasis on the market reopening. We welcome more investors to go into China and give more license to the investors from outside, and also get some very high level reform of the local capital market. We have some innovation in the market mechanism, etc. And the third one I would like to share is that the huge demand of the local inhabitants. You know, the population is so huge, but the investment assets of the local inhabitants, lots of them usually focus on the property assets. And now the local inhabitants beginning to switch their investment from property to some financial investment vehicles. So together, we think during the dual circulation strategy, Chinese government does have some possibility to attain a relatively lower but more stable economic growth in the next 10 to 20 years.
Could I ask a follow-up question about the dual circulation strategy? I think everyone would welcome the domestic demand part of that, but the domestic supply part of it has raised more eyebrows. I mean, it sounds like a step away from opening up towards a more self-contained economy. Rationale for that?
Okay, I will try to analyze the more clearly about the dual circulation. So firstly, I would like to say the Chinese government, in the announcement of the 14th five-year plan in the last year, so the dual circulation strategy, including different kinds of the views. The first one I'd like to say, the Chinese government decided to open their market, open their more license to outsiders. So from the last 2 years, more of the regulation, the local regulation, has lifted the restriction of the license of the local, like the security company or insurance company, etc. That's the first one. The second one is about the local government try to stimulate the local consumption, to buy more vehicles or more financial investments. So the local government is trying to give the local inhabitants more products to buy, and at the same time, because of the the pandemic has stopped some of the communication between different countries. So China is one of the first one to recover from the epidemic. So during the past year, more of the mechanism of manufacturing requirement shifted from outside to inside to local China. So that would also to help to stimulate our local formulation, our local consumption.
Patrick, could I bring you in here? What do you think are the big challenges facing China over the next 15 years in trying to achieve this goal? I mean, in particular, the demographics don't look great, do they?
Yeah, I think China has a couple of key challenges, and I think what's important about that is it's an opportunity for investors. The demographics are daunting. They have hundreds of millions of people that will be approaching retirement age. And China did not get mature enough to develop a fully financial infrastructure to allow the safety net that they need to create for their citizens. So despite all the trade troubles and the different difficulties and negotiations with the United States, financial liberalization is keeping pace in China, because China does need to open its markets and allow them to raise more capital. And these are a couple of critical things that are occurring with regards to that.
And this question of bringing in more capital, I mean, we think of China as being a very high savings rate economy, one that runs a current account surplus, a net exporter of capital to the rest of the world. Why does it need foreign money?
Well, if you look at their current account deficit, current account surplus, it has been in a large surplus for many, many years, but it's approaching zero. And as the country moves to a more consumption-oriented society, it is going to move to a deficit. So when we look at that, that is a classic example of when they start to need to raise more funds. If you also look at the balance sheet structure of China, the second largest economy in the world, and on a purchasing power parity basis, it's the largest in the world. They are actually structured like a small EM country, more like Greece and Turkey in terms of their balance sheet. They have over-reliance on bank loans. They have an under-reliance on equities and an under-reliance on fixed income. So from our perspective at Huatai, we believe that over the next 10 to 15 years, institutionalization, internationalization, equitization, securitization, these are big changes that need to occur. And this is why we think that this year, the liberalization of QFII is so important to investors, and it's so important to China. China is allowing new types of investors to get a QFII license, and this QFII license will allow them to access capital raising opportunities, and they will and also new access to hedging. In particular, our company has the largest private stock pool of stock lending that is becoming available to QFII investors. China has given licenses to companies that aren't so helpful in terms of being able to raise capital. In this new generation of QFII, there will be more investment funds, there will be more hedge funds, there will be more long-only institutions that will help China raise capital.
Kevin, let me bring you in here. Patrick's described this underdeveloped financial system in mainland China. How does Hong Kong fit into that, and is its role changing?
Yeah, I think the development is encouraging. I think from a number of angles. I think the first point is really when you talk about the institutionalization of that market. I think for many years we've talked about it being sort of 80% retail, and that's got certain behaviors and it gets us into trouble on occasion. And so I think with the overhang of that aging population, very, very clearly we needed that pension reform, and it's and I think it's going in the right direction. I think if I look at things like the assets under custody of the NSSF, for example, and many other funds growing in China, it's starting to sort of on the journey of evening out to what we sort of normally call a stable market. I think for Hong Kong, we still serve very positively with the Stock Connect scheme in particular. I think this year we've had record inflows, and I think today itself is a record day. So we'll continue to bring Western capital through the northbound channel into China. Within a blink of an eye, I think this year we've gone significant increase. Last I looked about a few weeks ago, already over the 2 trillion renminbi mark being held through Stock Connect into China. And so for Hong Kong I never like to think of it as competing with QFII. I think we're after the same goal here, which is to bring that institutional capital into China and normalize the markets that then make it more palatable to the pension schemes. But we will, of course, need to continue to evolve Connect schemes. I always say that the job of Stock Connect is really to make it like trading any other market, just a very short settlement window. So we do things like delivery versus payment. So if you sell your stock, you know you're going to get your cash, that type of thing. Think of things around best execution, etc. So on the other side of it, it's also important to understand that there'll be Chinese companies that want to raise offshore capital. So we continue to be that leading destination for Chinese companies to do that. In the IPO market is as robust as I'm sure everyone on this call can see.
My apologies. Do you think that Hong Kong's distinctive role is, though, changing, both because of the difficulties it's faced over the last 18 months and also the progress that mainland markets are making?
Yeah, look, I think if you just continue to, like any business, if you continue to stand still, then by the time you've realised it, it's missed you. So continually need to evolve in Hong Kong to support the goals of what China's trying to achieve. I still maintain that the role here is primarily to help China to become a more institutionalized market. We'll do our bit to continue to bring the Western funds up through the northbound into China and complement everything that QFII is doing. Down the path, we'll need to look at things like how do we partner together to increase the inclusion levels in major indexes like MSCI, for example, which is really at the moment only 20% of its China potential. That might mean things like offering offshore hedging tools and the like from those sort of angles. So it is naturally evolving and it will continue to evolve, and we really want to be part of that. And I think we often think about the domestic building of the Chinese capital market, and I think that's critically important. But don't forget as well, there's such huge asset bases there that's going to want to go from the east to the west, if you will. And so part of that evolution is making sure that Hong Kong Exchange is totally globally connected. You'll have realized we announced the suite of indexes for emerging markets in Asia, and it's hopefully not too far in the distant future that we've created a mousetrap that the Chinese would like to take exposure against. So if they want that emerging market exposure, or through to Japan or to Australia, they've got it in their home here in Hong Kong.
Let's talk a little bit about this east to west financial flow or capital flow. You just look at the configuration of global interest rates, you look at the configuration of global growth. Why would anyone in China want to invest in the rest of the world right now? Zhai Chenxi, why don't you take that question?
Okay, thank you. I'm here. Yeah, I'm very positive. Can you hear me? Is it okay? Yeah.
We can hear you.
I'm very positive about the outlook for the China and the West for the future. So I would like to share for three key supporting factors, I think. The first one is about the China's economic strategy. I've mentioned before. In this year, the government launched the 14th five-year plan and mentioned the dual circulation strategy. So given the increased trade protectionism sluggish the world economy, but China needs to rely more on domestic demand to drive its economic growth in the future. So, the consumption accounts for only about 38% of GDP in China, but 68% of GDP in US respectively. So the Chinese domestic demands have a huge potential to dig up. That's the first thing I'd like to share. The second one is about that we're saying the pandemic will stop in the near future, I think. So we will welcome the pandemic recovery in the near future. And The third one I'd like to share is about the future of the market reopening. So, in China, the how to say, as the friend from the Hong Kong Stock Exchange have mentioned, the bond connect and the equity market to reopen. So I have some data to share with you. At the end of October, the number of foreign investors in the bond market had reached over 2,000, and an increase of 75 new investors in October alone. And as to the equity market, so in this year, the cumulative market capitalization of onshore Chinese stocks from outside investor amounts to over 2 trillion RMB. So no matter bond market or equity market, both of them have a very increase of the investor from outside. So that means in the among all of the developed economies, as the interest rate is very low, but compared with the other countries, the Chinese local government, the bond is relatively high. The 10-year bond between the China and the US, the amounts to the historical high of above 200 bips. So in this year, many of the foreign investors goes into China. And also, as you have mentioned, the PBOC of China and Fed and etc., lots of the central bank have injected lots of liquidity in the market. But the Chinese People's Bank of China stopped the injection of the liquidity, or would like to say, back to the normal policy, the monetary policy from May. So that means in the near future, the RMB will appreciate in the near future. So that will make the local assets of China, RMB assets, more attractive to the Western investors, I think. Thank you.
Is there a danger that the RMB will strengthen too much?
That's a good question. How to say, as to our local Chinese investor, I would like to say the Chinese government also wait and see. So I would like to analyze a little more about why RMB appreciate within this year. Okay, I think there are two major the driving factor. The one is the fundamental economy, because before yesterday, so China is only one of the economy that stopped the epidemic. So in China, most of the economy back to normal during the past 3 quarters. So in the third quarter, the GDP growth rate jumps to the nearly 5% from the first quarter. That is negative 6.8%. So the economy of China is the highest one among the world. That's one reason, right? The second one is that it's about the monetary policy. The Chinese People's Bank of China is one of the more more conservative bank People's Bank, the central bank. So the Central Bank of China began to back to normal policy from May. That means the Chinese government has come into a normal monetary policy for about half a year. So that means the China has does have some the appreciation pressure to the economy, but the government maybe don't want to see such a rapid appreciation trend. So the PBOC also will do something to help to make it become more normal. So and at the same time, when the other country back to normal step by step, I think the appreciation trend and the will slow down. I think though the trend is there, but it will slow down after the other country back to normal economy. Okay.
Thank you. We've had a question from the audience about outbound investment. There's still substantial controls on capital outflows. When do you think China might liberalize those? Patrick, do you want to have a go at that question?
Sure. Yeah, we literally think that there is going to be movement by the Chinese government to allow QDII allocations to increase. We believe that as the currency looks stronger, there's certainly some concerns. I hesitate to say that China has a line in the sand type currency level like Japan typically does that drives investors' positive or negative views about the economy. I think investors have to continue to evolve their understanding of China because it's a 500 million population middle class alone that is very interesting. But from what we see here is that even if the currency appreciates, the consumer in China will have more choices about buying things overseas, and that will have some positive effects for trade concerns around the world. But we see from an institutional perspective that the Chinese government is likely to make some moves in 2021 with regards to allowing domestic institutions to invest overseas more. Secondly, there is a very large and latent opportunity by Chinese retail who are incredibly interested in overseas securities. My company is the largest retail brokerage firm in China, and we are the largest online trading app company with the largest online trading app on the mainland in China. We know that there is a significant amount of investors that are particularly interested in the US equity securities market. US companies are incredibly profitable and incredibly innovative, and the Chinese consumer demand for their financial wallet is to have that increase. And that's a business opportunity that we see and that we're very optimistic about.
Eric, could I ask you about this question too? I mean, given everything that Chenxi mentioned, the trend appreciation of the RMB, we've had some very good, obviously, returns in mainland markets this year. And also just the fact that PBOC policy is just much stricter than anywhere else in the world, higher interest rates on offer. If China did open up completely its capital account, did allow outflows, would there be any?
Oh, I certainly think there would be. And I think we have to imagine a world that's not too far away where not only we see portfolio outflows, but the tourism outflows recover as well. I mean, we talked earlier about the current account surplus in China. There was an expectation that we would go into deficit before COVID hit, but obviously the significant narrowing in the services deficit has been what has allowed the current account to remain in surplus. But if we go back to a normal or more normal world, we'll see outbound tourism from China. And I think that may coincide over the next year with more outflows from an institutional investor point of view. You asked the question earlier, in a world where 10-year CGBs are at 3.25 and 10-year treasuries are at 80 basis points, why would anybody move their capital offshore? Well, I think diversification of portfolios is a major driver of that. And we heard a moment ago about the interest in US securities. There will be interest in credit markets, both in US and in Europe, and emerging markets around the world in addition to that. So, I think as China's institutional markets start to evolve even further, things like portfolio construction and international diversification are going to become really important themes to the onshore investor.
Kevin, would you agree with that assessment? Do you see it in any of the southbound flows?
Yeah, certainly. Look, I'd just like to concur. I think there is a huge increasing demand for overseas securities from the mainland. Previous life of mine, I used to be seeing as a broker, seeing huge amounts of east to west flow from, let's say, offshore Chinese banks in Hong Kong, servicing, let's say, high net worth individuals and whatnot. That flow is incredible, and I doubt very much that it's got any smaller. The other thing that we do see clearly when the renminbi strengthens is that massive increase in the southbound volume. And I suppose the mind probably imagines that it's buying Tencent and Alibaba, and well, it's not Alibaba yet, not Connect eligible, but Xiaomi and Meituan, etc. But we do see an increasing amount going into to more international names like AIA, for example. It's not inconceivable, I suppose, also that another way of coming into and accessing international names via Hong Kong would be looking at structures like Yum China, for example, that would carve out its Chinese enterprise and list that here in Hong Kong. And I don't think it's inconceivable to think that there'd be more of those type of structures coming. IMAX was probably the first of that some years ago already. And then again, it's not inconceivable to imagine that that would be made available to the greater China financial ecosystem.
Perhaps we should talk about some of the sectors that might take advantage of financial flows either way. We've had a question from the audience about sports and TMT investments from China, especially in large club deals where PE funds can participate. In particular, in the context of China's focus on the World Cup. Do you see that sort of sports and TMT sector being one of the growth areas for China?
So, question for me, sorry? Or...
sorry, if you'd like, sure. Otherwise, why don't I throw that over to Zhai, Chenxi? Oh, Patrick, please, if you're keen.
Sure. I think that the Chinese individual as well as institutional investor is as diverse and varied as we see in the U.S., U.K., et cetera. The interest in some thematics are going to be very high. I can't speak specifically of the material information I have regarding the sports events, but the interest in thematic areas such as that are going to be very high. We see a lot of interest in investment flows that participate through our company into the electric vehicle market. Global electric vehicles is very important. I think we also see different themes emerging among consumers, consumer pet health, both overseas and in China. Chinese are increasingly looking at things that are of interest to them, that they see evolving as a market in their own country, and then they're applying it to some of their investment strategies, both retail but especially institutional, as they invest overseas.
We haven't talked a great deal about the US, and partly that presumably reflects the election result we've just had. But we have had this sort of interesting period in which the kind of financial reforms that China has made have not been of great interest to the US administration. So we've had a 4 or 5 year period in which reforms that might have impressed a previous administration don't seem to have been particularly impressive to the Trump administration and Robert Lighthizer in particular. My question is, if, as seems certain now, we have an incoming Biden administration, will we revert back to a situation in which America is pushing hard for financial opening up and sees that as a major concession from China that it can then use to quell constituencies demanding even greater change? Will we see a sort of return to the Obama-Biden era in the negotiations with China? Eric, why don't you have a go at that one?
Sure, Simon. Look, I'm a little bit hesitant to say that we would go back strictly to the regime that we saw under Obama and Biden. And the reason I say that is, I suppose, just a bit of caution about the fact that, one topic that seemed to gather, support across both sides of the aisle in the United States was taking a tougher line on negotiations with China and expecting more in return from China. And it's not just the opening up of financial markets, the financial sector, but a number of the topics that the Trump administration focused on. Now, I think we will see perhaps a more predictable or a more constructive approach to the whole suite of negotiating topics. But I don't necessarily think we'll go back to what we saw under Obama and Biden in terms of Biden's first time in office.
Patrick, what do you make of the potential for a Biden administration in its relations with China?
I think a couple of things. I think that the approach is going to be more traditional. It will be multilateral. There will be opportunities for China to present itself by saying, look, we're doing all of these types of things across different sectors. It will not come down to just whether it's agricultural purchases or not. It's going to be financial. It's going to be agricultural. It's going to be about intellectual property. So I think there will be a better opportunity for China to show itself as a negotiator. But on the other hand, things have materially changed, and it can't revert. There is we are in a new world of concerns about IT security, not just intellectual property, but truly privacy and issues that we're now seeing crop up, not just as it relates to China. It relates to EU and Amazon. It relates to U.S. companies operating in the U.S., the media companies and the internet companies. It's not going to be the old way. There will be China is a strategic competitor, and there will be negotiations that will treat China as such.
Zhai, Chenxi, I'd be keen to get your perspective on what you expect from a Biden administration.
Okay, but actually, as to the Chinese people, the local Chinese people, it's difficult for us to decide which one will get elected and about their policy. But as to our Chinese people, I would like to say, if the election is finished, that will be a good thing. That will be positive because more stability will anticipated post the U.S. election. So as all of the friends have mentioned about the opening and financial industry of China, so I would like to add some information to you all. So firstly, I would like to share is that the Chinese government decided to open the financial sector of China. It's quite different. It's quite different between this period and the 5 years before. So I have some data can share with you. Since 2 years passed, since 2019, we can see the list. We have 5 new foreign controlled security company, 2 foreign controlled fund management company, and 20 private security investment fund managers and international rating agencies such as Standard & Poor's, Fitch have entered the Chinese market. And as we know, the CSRC and CBRC are also get more approval on the process to more US company or more European company, etc. So I think China is also on the changing period. They're trying to reopen their market, especially in the financial industry. So it's a little different, I think. So I truly hope that all of the financial industry investor pay more attention to this reopening period and opportunity.
Kevin, we've seen a number of these homecoming listings, these Chinese firms listed in the US doing follow-on listings in Hong Kong, or companies that might previously have decided to list in the US, listing in Hong Kong instead. Has the trade war, has US tensions been good for HKEX?
It's hard to comment on that. Look, I think the tensions clearly saw a consideration from a number of Chinese companies to come back to Hong Kong, if you will. I think the catalyst for that was actually the restating of our listing rules to allow for weighted voting rights. If you can recall all the way back, I'm not sure how long you've been in Hong Kong. Alibaba himself initially wanted to come to Hong Kong, but we just didn't have the regime to accommodate it, and off to America it went. It's only since we've done that we've been able to welcome these companies back. So, is it down to the fact that we reformed the listing rules? I tend to think it's a lot more to do with that. Was it catalyzed by certain trade tensions? Probably. Will it continue in the future? We certainly have a very healthy and robust pipeline, as I've mentioned. It's also, it remains to be seen, I think, how that tension will either dissipate or or plateau.
Eric, it's been mentioned, I think perhaps you mentioned it also, that America will potentially pursue a more multilateral approach in its dealings with China. Could that end up being more difficult for China to deal with, even if it's more predictable?
Look, there's two very different interpretations of that topic. The first of which is that if the US is looking to positively reset its trading relationships with its historical allies and trading partners, then you have a more unified front. And there is a view out there that says that that would make life much more difficult for China because they're now facing a collective rather than a disparate one. I think on the more constructive side, one of the really fascinating economic aspects of the current crisis is that actually emerging market exports have recovered to their pre-COVID levels in 2 quarters, right? It's been a very quick recovery for emerging markets, especially in Asia. And a lot of that has to do with intra-regional trade. And so I think to the extent that the Biden administration wants to pursue a more constructive and multilateral approach to global trade, that's going to be a net positive for the region in Asia generally. And China is a massive part of that growth engine. So I lean in the direction that it's a net positive, but there will be some skepticism about that.
Zhai Chenxi, one of the unique aspects of China's rise is that it has legitimate aspirations for its currency to become widely used internationally. And also, the threat of US sanctions has also motivated China to look to decouple from the dollar. What do you think are the prospects for internationalization of the RMB now that trade tensions seem to be settling?
Okay, thank you. That's a good question. I think as to the Chinese government, during the past 4 years, it's quite tension for the Chinese government to, to balance the tension between the US and China. So, and the Chinese government does put more emphasis on the safety of the financial industry and technology industry. I'm not sure whether the Chinese government will decrease the USD reserve or other use, but Chinese government does have the decision to make RMB more internationalization. So that's also the reason why the Chinese government decided to welcome more institutional investors to go into China to buy the local equity market and the bond market. Stimulate more issuers to go to Hong Kong Stock Exchange to issue bond or to issue to get listed. So to conclude, to sum up, is that Chinese government is trying to learn how to balance the RMB internationalization and how to use the still as a reserve currency. So Chinese government to make a balance and begin to learn, I think.
Thank you. We've come to the end of our session. I want to thank you all very much for your contributions and your thoughts. It is a new dynamic, I think, between China and the US, even if some of the dramatis personae, Mr. Biden in particular, are quite old. Thank you very much for your conversation.